The indications are not good for this week, particularly what happened overseas. A lot of interest in what's happening with today's market here in the States over what happened, particularly in China overnight.
Certainly. But look, we have seen the Dow run up about 3,000 points since the lows of March 9th. But how do you keep your portfolio focused no matter what the markets are doing? Monty Guild, Chief Investment Officer of Guild Investment Management, and Tom Lydon, editor at ETF Trends, joining us right now with some ideas. We were just chatting with Monty, and something jumped out at me of what you said. We said, look, overnight China had this big fall of more than 6%, the Shanghai Composite. You said that's a buying opportunity. But I said, how much further do we see the unwinding of that market before it's the best buying opportunity?
Well, in our opinion, it's about 200 points, Liz. It'll be a 50% correction, 200 points more, or about 7% more. China will have pulled back 50% of its recent rise.
That's well, and when you're looking at a stock to play for this, you think of FXI, you think of these sort of basket of funds that involve China, but you're not crazy about specific Chinese, like China Mobile, for example. Why not?
Like some specific Chinese stocks in banking, insurance, consumer, but China Mobile is overcompeted. Their competitors are coming in with new products and new services, making it difficult.
Tom Lydon, let's bring you in here. You're actually a bit more bullish as each day goes by. And what's behind your thought here? I know you as an ETF guy are looking at so many different screens, but what brings together the composite picture of this market where you say, I'm not worried about a day like today where we're pulling back 73 points?
I agree with Monty 100%, and I love his hairstyle as well. I'll tell you.
The two of you together, yeah.
I'll tell you, as Teddy said recently, boy, you know, it's a buying opportunity. If we get a little bit of a pullback here, and as investors are putting away their bathing suits and starting to open up their brokerage statements and look to see that this huge run that we've had off the bottom, it's tremendous. History does repeat itself, and although some people are concerned about September and October, if you look at 2003, the last time after a 45% decline in the S&P, the market ran up through the spring of that year, all the way through September and October. It was a wonderful run, and if you sit on the sidelines, you might be missing out.
Understood.
Again,
but Tom, let me just be specific, because you, like Liz and I, love the Russell 2000. We love those small and mid-sized. That's the backbone of the economy. I like to invest in it, but at the same time, it's up about close to 70% from its March lows. Hasn't it played out already?
Well, you could pretty much say that about all the sectors, David. I mean, if you talk about China, the same thing. But the key is during recessionary times, when the tide starts to turn, it usually is the small cap companies that they're nimble, they're a little bit quicker to react.
By the way, the sticker is IWM if you want to play the Russell 2000.
That's right, and the other aspect is technology. Technology's been on fire. We've got a lot of companies with a lot of cash. That's the triple Qs as well. And emerging markets, 50% of the GDP markets right now are based in emerging markets, and the EEM is another great ETF to consider on these corrections.
And there we are today with the EEM. Monty, gold and oil. Oil today is having a pretty significant pullback, and gold too. Gold is coming down. Where do you feel that people should find sort of a portion, whether it be a tiny slice or a bigger chunk of the pie here, for gold and oil in their portfolio?
Well, Liz, we believe that gold and oil should be at least 20% of your total portfolio.
20%.
Because we see the U.S. dollar declining, and they're great hedges against a declining dollar.
What about, can I quickly ask you, how much in cash should a portfolio have right now?
Currently, our global portfolios, we're global macro managers, are about 40% in cash.
Wow.
We're out of the U.S. and Europe almost entirely.
Can I interpret that as a bet that we'll see a down leg in this market?
We think China is getting cheap enough to buy, but everything else is too expensive to buy now.
So wait for that final 7%, 8% pullback in China, and then you're going in like gangbusters.
Yes, sir.
All right. Great to see you both. Tom Lydon, Monty Guild.